Hello, I'm Nick Parker from jpmorgan. Well, it's already looking like an eventful year ahead for emerging markets. And joining me to discuss his outlook for 2018 is Luis Oganes. He's the head of currencies, commodities and emerging markets at jpmorgan. Luis, thanks so much for joining us. Appreciate it.
Thank you, Nick.
So looking ahead, one of the big trends is that developed markets, in particular the US Federal Reserve, look set to further tighten interest rates and monetary policy, which can lead to an outflow of capital from emerging markets. But you're predicting growth in 2018.
We are predicting growth, and we're actually not expecting a big turn in the capital flow dynamics into EM. We still expect capital inflows to come, maybe in a little bit more of a modest pace compared to this year. But we think that the magnitude of rate hikes by the Fed is not going to be enough to turn the dynamics around for flows into emerging markets, to the extent that emerging market fundamentals are positive, including a stronger growth.
One of the big questions, of course, is over China going into 2018. You're predicting that growth there will slow to 6.5%. What impact do you think that will have?
I think that the world likes when China grows a lot, but the reality is that that growth has been quite reliant on credit creation, and the amounts of debt and leverage in that economy has reached degrees that I think need to be reined in. The authorities, I think, understand that, and part of the deceleration next year that we are penciling in will be actually driven by policy tightening. So we're actually looking for some modest deceleration from 6.8 to 6.5. We don't think that that necessarily is going to generate too much pressure on emerging markets, on global growth, on commodity prices. So it's actually a very modest deceleration. Obviously, we need to watch whether there is determination from the authorities to decelerate further, but that is not what is being penciled into our forecast right now.
Indeed. And India, on the other hand, had seen a slowdown as it implemented some of these landmark reforms, but you're now predicting a recovery.
We actually, when we saw the deceleration, some prices of negative, slower growth prints during the course of 2017, we always saw them as temporary because of the reforms that you are mentioning. Now we're starting to see the data flow actually pointing up, and we think that it's going to continue displaying some recovery in 2018 compared to this year. So the projection that we have above 7%, maybe 7.1, 7.2, is certainly higher than this year, and it's still going to keep India among the highest growing countries in the planet. So we're, from that perspective, constructive.
And looking ahead to 2018, what do you think are some of the biggest opportunities in emerging markets?
So we're looking, in general, if you look at returns for emerging market fixed income in 2017, they were on the high side. They were the outperformers globally. We think that our performance is actually going to continue next year, but in a more modest, cumulative return fashion. So we're looking at returns between 6 and 7% for EM fixed income. We actually have a more constructive view on EM equities. The projection is that it could be around 15%. And again, this is because the positive fundamental backdrop, we don't think that we think it's strong enough to withstand the headwinds that are going to be coming from Fed tightening.
And what other risks do you foresee going forward in terms of potential headwinds?
Well, again, the market is not, even for the 3 hikes that the Fed is telling us that they may do, our house view is actually that the Fed could actually deliver 4 hikes. The market is not pricing those in. So to the extent that these get priced in a very fast way, just because there is a high inflation print or there's very strong communications from the FOMC, that can certainly surprise markets and lead to pressure on emerging markets. But again, I go back to the positive fundamental backdrop, the fact that current accounts are smaller, reliance on capital flows are actually much more modest in EM. So all this tells me that a lot of these pressure points, and whether we see sell-offs during the course of the year, they will most likely be used as an entry point, as a buying opportunity, as opposed to a signal to pack and leave.
Luis Oganes with his outlook for emerging markets in 2018. Thanks so much, Luis.
Thank you so much, Nick.
And follow jpmorgan to learn more.